Hi everyone, Mike Salisbury here, Portfolio Manager with Strong Private Wealth of Raymond James. Here's a quick market update from the last month for our clients and anyone else who's interested. May was an okay month relatively speaking, given the bumpy ride we've had so far in 2022, with both the S&P 500 and TSX Composite roughly flat on the month, and the Canadian dollar appreciated relative to the US dollar by about 1%. Sectors that led on the month were energy and utilities, with most of the upside continuing to come from the oil and gas industry. The laggards during May were the real estate and consumer discretionary sectors. Domestically, we saw Canada add about 15,000 jobs in April. However, this underperformed what the consensus estimates were of the economy adding 50,000 new jobs. This brought our unemployment rate down to 5.2%, while Canadian job vacancies reached an all-time high with more than 1 million positions looking to be filled. This tells me that there's definitely a job for every Canadian, just not the kind Canadians are looking for. In April, Canada saw slowing home sales largely as a result of increased interest rates. However, Bank of Canada Deputy Governor Carolyn Rogers was quoted saying she still saw Canada's housing price growth as unsustainably strong. This is important to note as the Bank of Canada had another interest rate announcement on June 1st where they raised rates another 0.5% to bring the overnight bank rate up to 1.5%. For context, we were above this level at 1.75% before COVID, and we started this year at an emergency target rate level of 0.25% put in place during the pandemic. That being said, both BMO and Bank of America have both come out predicting that the Bank of Canada will raise rates another 0.75% in July, with BMO saying another 0.75% raise is possible in September. This would push the Bank of Canada overnight rate up to 2.75% by September. BMO also came out with a separate note saying homes in the Toronto exurbs are overvalued by just over 76%. For those of you wondering, these are the cities they define as exurbs. This is a factor we are focused on, as any slowdown in the housing market will have a broad effect on the Canadian economy. The reason for these rate hikes has largely been inflation, with the Canadian Consumer Price Index up 6.8% year over year in April, with a 9.7% increase in groceries, 7.4% increase in shelter costs, and 36.3% rise in the price of gasoline. Beyond our borders, the effects are still being felt from COVID in the form of lockdowns in China as they continue to pursue a zero COVID policy. This caused disruption in supply chains as well as demand destruction within cities that had lockdowns, most notably in Shanghai. This is on top of the continued effects we feel from the ongoing conflict in the Ukraine, which is raising the price of both food and fuel globally. Speaking of rising prices, in the US, just like in Canada, inflation is hitting levels not seen since the early 80s. To combat this, the US Federal Reserve has already done a 0.25% and 0.5% rate hike in March and early May, respectively. US Fed Chair Jay Powell has come out saying that he feels 2 more 0.5% rate hikes are appropriate. This is good news for the markets, as it takes the prospects of a single 0.75% rate hike largely off the table, making interest rate increases easier for both the consumer and capital markets to stomach. This seems to be working as the consumer confidence remains well above long-term averages. The silver lining in this is that despite elevated inflation, S&P 500 earnings per share for the first quarter of this year were up just over 9% year over year. If you're a current client and want to know how this will affect your portfolio, please reach out to us. But if you're not a client and still want to know how this will affect you, give us a call. We'll be happy to help you out. Because at Strong Private Wealth, our goal is to help you live a life well invested.